Hello, everyone. Welcome back to SEC Roundup. My name is Tom Zucchero. I'm a member of the board of directors of ICAN. And with me is my fellow director and companion in SEC Roundup, Nick Morgan. Hi, Nick.
Hey, Tom.
And we're delighted to have this very special guest today, Gail Bernstein, who is the general counsel of the Investment Advisor Association. Hi, Gail. Thanks for joining us.
Hey, Tom. Hi, Nick. It's a pleasure to be here. Thanks for having me.
Our pleasure. So today we're going to talk about another of the SEC's recent and controversial rule proposals. This one dealing with the custody rule. This rule was amended about 12 years ago, post Bernie Madoff, to ensure that advisors could demonstrate custody of client assets. The commission now has proposed a rule change, which seems to be in reaction to recent crypto crises, which have been in the news. But Nick, why don't you tell us a little bit about the proposed rule?
Yeah, Tom, thanks. So obviously the investment advisor custody rule has been a big deal for a long time. It's important for advisors, and it presents compliance challenges, and it's been the basis of enforcement action. So the topic generally has been around for a long time, and it's been an evolving issue. There have been comments and guidance and clarification by the staff, and we learn more, as we do in all areas of the SEC, with enforcement actions about the staff's interpretation, the commission's interpretation. So this doesn't come out of the blue. This is not like just didn't drop out of the sky. But as you said, in connection with some of the crypto implosions and bankruptcies, where the issue of who has custody of digital assets has now sort of come to the fore, this proposed rule comes out last month. And so the phrases that come to mind when I looked at the rule, because originally you think, oh, it's only going to impact crypto assets, maybe it's not that big of a deal, but no, it goes a lot further than that, and Gail will talk about that. But the phrases that come to mind are either bad facts give rise to bad law, or never let a crisis go to waste. This proposal addresses a whole bunch of things, and it's really, I mean, if it's finalized, it's going to have a huge impact on the investment advisor industry, not just with relation to crypto assets. So I think it's something we kind of need to pay attention to, comment on, and see if we can get the SEC to make it better in the event it gets finalized.
Thanks. So Gail, you and your association have been somewhat critical of the rule, and there was a Bloomberg article in which you said the rule was a hammer. Tell us more, give us a little bit more insight into your views and the association's views about the rule.
Sure. Thank you both, and thanks for the background. Let me just start by saying that it's a 434-page rule, and we at the IAA are just still at the beginning stages of working through it. But as you've noted, it is proposing pretty major changes. And we definitely have some preliminary reactions. And one of them, you're right, is that it is taking a hammer approach to what should have been perhaps a scalpel approach. What is clear to us, even at this point, is that the extent of the changes that are proposed is absolutely mind-boggling, not just as to scope, but as to what is going to be required operationally. So the first big change is the name and the fact that it is going to be moved out of section 206(4) into this new proposed rule 223-1, and it's going to be called the Safeguarding Client Asset Rule. What's maybe a little bit important here is that it may be being moved out of an anti-fraud rule into a little known and little paid attention to Dodd-Frank section. But there's a footnote in the 434 pages that says that the SEC is going to retain its authority to bring cases of violations under 206(4)(2). So it's not, don't get too excited yet. So the second general point that I'll make is that while the aspect of the proposal that is getting the most attention, as you both said, is the expansion of the rule to cover all assets, including crypto, one of the big stories from our perspective is how this proposal is going to affect the thousands of smaller SEC registered advisors that are already struggling under what is a crushing weight of this ambitious SEC rulemaking agenda. the likes of which I have never seen, and I'm sure the two of you have never seen. 88% of SEC advisors have fewer than 50 non-clerical employees and only 1 or 2 officers. So they are small businesses by any rational measure, and they face unique challenges that small businesses face. The custody rule proposal is one more massive regulatory change coming at them at unprecedented speed. And if it's going to be finalized, it's going to add to the cumulative burden of all the existing and upcoming regulatory requirements. This has been an area on which the IAA has advocated for years, and we're redoubling our efforts now, given the current regulatory landscape. There is one very positive aspect of the custody proposal in this regard. It would give some leeway to smaller advisors by giving them a longer compliance runway. So 18 months versus 1 year for larger advisors, and the threshold will be $1 billion in assets under management. It's still going to be too short a compliance period for everyone, but we do appreciate the SEC's recognition of the strain on smaller advisors and the effort to provide some accommodation. One last general point, and then I promise you I will get into the weeds. There are going to be aspects of this, again, 434-page proposal that are very likely to be inconsistent with elements of other proposals or existing rules. There are literally thousands of pages of open proposals out right now that will directly affect investment advisors, with little suggestion that there's been a holistic review by the SEC of how all of this is supposed to work together. So now that I've set the stage with some of our very real concerns about unintended but highly likely consequences, I'm going to get into some of the details. So again, what's getting the most press is crypto. It's probably not going to be the most consequential aspect of the proposal. The proposed rule would expand in scope from covering only funds and securities to also including other assets: crypto, derivatives, options, bank loan participation, artwork, corn, real estate, precious metal, physical commodities other than corn. And one practical change is that custodians often include these types of assets on account statements as an accommodation to their clients. This will be prohibited, but it's not yet clear how the proposed qualified custodian changes, which I'll touch on in a minute, will affect this. So crypto, Chair Gensler has been quite open about his intention for the SEC to regulate crypto. And what this proposal will do is allow the SEC to regulate these assets to quite a large degree without having to determine that they are securities. But perhaps the more interesting question for crypto is whether these assets will in fact be able to be custodied at all under the proposed rule. And if they won't be able to be custodied, will advisors even be able to invest their clients in crypto assets, at least on a discretionary basis? So, as with some of the other new types of assets that would now be covered, many of them probably also won't be able to be custodied with a qualified custodian, especially with all the added requirements that custodians would have to meet. With the addition of all discretionary trading, this is also likely to have breathtakingly vast application, and it's unclear how it would be operationalized. Another staggering change would be to have custodian agreements and obligations. There are proposed requirements, that advisors are going to have to enter into written agreements with qualified custodians. Today, a client, whether retail or institutional, typically enters into a two-party agreement directly with a custodian that it chooses. This proposal is going to turn these relationships completely on their head. It's going to require that every advisor that uses a qualified custodian must enter into a written agreement with every single one of the custodians used by its clients. And most advisors will be working with more than one custodian. These written agreements will require the custodian to undertake 4 specific things. It will also require that the custodians provide assurances, reasonable assurances, and I believe in writing as well, that the custodians will do 5 more things, and these include indemnifying clients against losses caused by the qualified custodian.
No, that's very helpful, Gail, and obviously we hope for a robust comment period where commentators like yourself and other interested advisor associations bring these issues to the SEC's attention.
Well, Tom, I will just add that we just joined a letter, several trade associations signed a letter asking for an extension for, in connection with this rulemaking. Unfortunately, it's not the first such letter that we're all submitting, and I'm not holding my breath.
Well, fingers crossed that the SEC does the right thing.
Yeah.
With that, we'll conclude this episode. Gail, thank you so much for joining us. Really pleasure to have you and get your insights. Nick, we'll see you again at the next SEC Roundup. So thank you very much.
Thanks for having me.